This week's Hump Day Holler coming to you in a little afternoon edition. Reason being is the Fed. The Fed is speaking, wrapping up their May meeting, and James, bring you in, James Parker. You know they did exactly what we said they were going to do, James, and they increased the Fed's rate by 0.25, James. So, we are now looking at, for those who aren't keeping score at home, who are relying on us to keep score for them, we're now looking at in 1 year's time, the Fed has raised rates from zero, the federal funds rate from zero to now a range of 5.25. So, this is having a huge impact. And now that they've just raised hikes again, I'll get into my thoughts in a second, but this continues to exacerbate or prove that they're just absolutely clueless, clueless on monetary policy, on what is going on, James. And, oh, by the way, uh, within the past week and within the past 45 days, we've had the third, fourth, and fifth largest banking failures in history have happened.
Okay. So my take on it. Immediately, I want to go to a chart here that looks at the history of the federal funds rate and notice that. Um, Here, let me put in a different little window there.
Yep.
So even though it has spiked up quite a bit as of late, here, make it a little bit bigger. You see that little thing on the end there where it spiked up as
Yeah.
of late? It's about where it was, maybe a little below where the federal funds rate was for the 90s. See all this 90s stuff right here? We're still a little bit below that. In the 90s had a rip roaring economy. It was pretty damn good. Now, I also go back to the 80s and I remember, aside from the first few years where, there's a big high mess of interest rates, they were still above where they're at there and we had a great economy. So the problem isn't necessarily that the federal funds rate has gone up to this level. The fact that
Pace.
it's changed so much so quick, and it's
Pace.
also the fact that we had a decade of bonds that are now just dead weight. You're just holding cinder blocks while you're treading water if you have bonds, and that's supposed to be the underpinning of any financial system, and we've just put cracks all in it.
Well, that's supposed to be your guarantees, right? Your bonds. Those are supposed to be your fallbacks. And again, it's not where the number is, it's the pace. And this is absolute shock and awe when you have within a 1 year in a 1 year time frame, a federal funds rate go up by 5.25%. That affects everything. And when you're looking at this, here, newsflash here, and James, we said it when we did our whole piece on Silicon Valley Bank, folks. There's going to be more, and what bothers me is when Jerome Powell, who may still even be speaking, when he talked about how they feel like the policies they have in place are strong policies, and they're not. The data is based on past, not where we going. Their policies are based on what was, not what will be. And that is where we have concerns, and where I have concerns on everything that is going on right now. And so it's easy. And let me even break this down a little bit more when I say there'll be more bank failures, because people go, who cares? What does that mean? Right? If it's not mine, or hey, I don't have over $250,000 in a certain account, right? So what do I care? I'm insured. Folks, with this rising rate and this rapid rate of pressure on banks, what it means is billions upon billions of deposits are being withdrawn out of the out of the banks. I've done it. I've taken my money out and went and put my stuff in short-term treasuries, money markets that are giving me 5.5% over a 6 month period. So what that causes is pressure on banks. Because what do we go to banks to? To lend money, to give us money. Well, when banks are losing all these deposits, what do you think if you're an investor, if you hold stocks in certain banks and these banks are now losing liquidity, they're losing deposits that they lend off of. They've now got to go do what, James? They got to go try to raise funds. So they're coming to you, me, whoever, Wall Street going, hey, you want to come invest in Bank of Schmuck? We just had all our deposits taken out. Our stock is plummeting. You mind investing in us so we could try and stay open and keep our doors open? Well,
Right.
the answer to that is no.
Yeah. And I find this easiest to understand if I use a more tangible metaphor than just dollars and cents that are just
Okay,
floating
go ahead.
around digital currency. So this is like a couple years ago when the price of lumber went from $300 to $900. And that's the input. So the cost of your house is necessarily going to go up. That's going to make it real hard for the people that are building houses to turn a profit on the houses they already started. They already got the contract. Someone
Right.
already gave them $300,000 to build this house, and now it's going to cost them, instead of $200,000, it's going to cost them $400,000. And what do? Not build the house, give the money back? Well, you're going to lose there too. So you just have to keep plowing forward and hoping you can survive until things get back to normal. But now that things are getting back to normal, you're having big problems because it happened so fast.
And the biggest thing the Fed, right, with their big thing, that the S on their chest is we got to get GDP to 2%. Whatever. I don't know where, how, who, whatever came up with that number. But the bottom is right now we're under 1% GDP, James. So if this is what it looks like under 1, what do they have to do to get it to 2? And in my opinion, it doesn't look pretty. So then you speak out of the other side and you go, well, Dwayne, you always sit here on Mortgage Gumbo, you and James. And these are the questions I'm having in the conversations I'm having with you, the Gumbo Nation. Well, Dwayne, you and James always talk about the federal funds rate does not affect mortgage rates. It doesn't, let's just say, directly. But technically, what does is inflation. And as we continue to do what they're doing, because they're looking at the numbers just don't make sense, it's not letting things work themselves out. That's why we can't have the rates be where they should be right now. The rates right now should be, based on all the data, mid to upper fives. But it's not because the Fed keeps getting involved. Think about it. They just raised rates. This is their first meeting since March, when they told us they were stopping. Remember in March, they said we're done. And then he just finished up by saying, somebody asked, so what are you going to do in June? We're going to leave ourselves open until we can get this under control, blah, blah, blah. They're clueless. And I know we continue to say that. But my biggest concern is not from the mortgage side. My biggest concern is from banking sectors. And I think what people do not understand, because you know why it wasn't big headlines about this other bank going under, James? Because right after it said, hey, bank of whoever goes under, you know what was right in the fine print that they don't want you seeing?
Was this JP Morgan bottom up?
JP Morgan Chase buys all deposits.
I,
Right?
I felt the same little suspicion there too. I saw
Right?
the same
So
thing.
now you go, Dwayne James, why is that funny? Why is that, folks? You don't want one bank. When the largest bank buys up the second largest, that's not good.
Yeah.
That's not good. And I know what we're talking about here. I just want folks to have an idea of really what is going on. And that's what we sort of use this Hump Day Holla for, to kind of keep you updated. So that's not good when Chase buys up the deposits on this. It's great for those depositors, but it's not good for you and me, the community banks who have a purpose to be in that community, for the regional banks who have a purpose to be in a certain region. They know their market, they know their client. National companies don't. It's the same reason why you all come to me to do your mortgage. I'm local. You could touch, feel, taste. You know I'm local. Same thing when it's coming to your banks. You want to work with folks who are in your market, who are here, that know what's going on.
All right, I want to run a headline by you.
Okay.
Quote, this is Warren Buffett here. Or, I'm sorry, Charlie Munger, but Warren Buffett was standing next to him and approved it too. Berkshire Hathaway's Charlie Munger and Warren Buffett are both issuing a warning for U.S. commercial property market. And they say there's a bunch of bad loans out there, and there's going to be a storm brewing in the commercial property market in the United States soon. Is this what you're seeing?
Yeah, I mean, I don't deal on the commercial side, but I have commercial bankers, and absolutely, absolutely. Because
Oh.
see, commercial is a lot of when you're doing commercial loans, James, and this came up on Gregory's show on Saturday. See, commercial loans, they're all making these loans on these adjustable, these interest only for a short period of time. Well, when that teaser rate expires, they're now looking at 5.25, which is our prime rate right now, plus whatever margins are put in. So payments are going on. So when you own these, let's say you own a strip mall with 5 tenants in it, okay? You already have leases to James, Dwayne, Mortgage Gumbo, Santa Claus, and Mickey Mouse. Well, when your bill comes due and now your payment to that bank changes, you can't just go to Dwayne, James, Mortgage Gumbo, Mickey Mouse, and Santa Claus and say, hey, got to raise your stuff. You're in a lease. You have a contract. And the bank goes, well, sorry, here's the deal. So you are going to see on the commercial side a lot, big time. Big time, I think you're going to continue to see that.
Is there a similar contagion in the residential?
I no, because people in residential, and again, we continue to talk about this, and I got a stat for you. I'll give it a second. In residential, people have more equity than they've ever had. Right? James, 76% of homeowners in this country have $100,000 of equity or more. That's 3/4. So you can't have that, right? Because at the end of the day, it's James, get out your house. The bank will be more than happy to take over James's home when he's got a Dwayne, anybody. More than happy to take your house back with all that equity.
Sure.
Whereas in commercial, it doesn't operate like that. Right? Because in commercial, how many people are out there can buy a strip mall?
Very few, yeah.
Right? Or willing to buy a strip mall. Also, James, in today's economy, think about now you don't even have the guy who bought the strip mall whose payment went up. What about those businesses that are in the strip mall that are being impacted?
Yeah, in fact, I heard a report earlier this week that said more than 1/3 of San Francisco's restaurants have closed since the pandemic, and it's not because the lockdowns; it's because people stopped going to work, and so they work from home and they don't go out to eat at lunch anymore.
And that's what this comes down to. So, look, we'll keep an eye on the Fed. As we look at the data, we told you 2 weeks ago, James, the Fed, the thing about the Fed, they're so predictable. We said 2 weeks ago the Fed was going to raise rates, and everybody's like, what? No way. They can't help themselves. They cannot help themselves. So we'll continue to keep you posted. Now, here's some good news. We've been talking about this LLPA. Even mentioned a couple weeks back. I'm like, people are going to try and fight this. It's going to be after the fact, but we're now up to over 30 states or trying to get this repealed or get this canceled. Doesn't mean Biden's taking your call because, again, the states can repeal it, but because nobody voted, this wasn't a constituency thing, Congressman or Senator Dwayne Stein, really, my answer to that is, hey, I had no control over that.
Boy, I sure do hate that for you. Right.
Right. But so they're starting to try and push to see about getting this stuff scrapped, The good news is, hey, folks like us are out here talking about it, explaining what it is. It's still there. And again, are we telling you, oh yeah, you should definitely wait? No, we've been telling you now, don't wait. Don't wait. Because the data shows rates are going to go down, mortgage rates are going to recede, and when they do, home values went up again in March. So home values are continuing to go up. So will that person with $100,000 in equity, what is the number? See, what we got to worry about, Gumbo Nation, is this. For existing home sales, what is the number of those 3 out of 4 people that have $100,000 in equity? What is the number for them that they're willing to say, hey, you know what? I'm going to take that, move out of my $300,000 house, take that $100,000 and go buy a $500,000 house. So then my payment, even though my interest rate's a percent and a half higher than where I'm at now, it's kind of what, and I'm living in a bigger house. That what is that number? We don't know, right? We don't know. We did it a couple weeks ago and people were saying 5.5, 5 and 5.25. Slow your roll. Slow your roll. But even more importantly, James, is that 76% that have 100,000 in equity, not only when will they send their house sell, but how many of those 3 out of 4 people, that 76%, are drowning with $800,000 car payments, who today's decision just added to their debt load when it comes to their credit card payments, student loan, all that stuff just went way up. Right? So how many of those folks are going to go, it sounds good that I've got $100,000 in equity. But is that 3.5% buying your bread and milk? And again, refinances, we're at 50%. Refinances are down 51 to be exact, down 51% year over year. So you go, my gosh, that's half. That's a ton, Dwayne. Just in January, it was 82%. People are hurting. And the Fed doesn't think you're hurting enough. That's my statement today. People are hurting, but the Fed doesn't think you're hurting enough, and their whole goal is to inflict more pain. Because they look at these goofy made-up ADP reports that nobody believes anymore. Right? Because it counts part-time and 16-year-olds and people dressed up like Easter bunnies and, all these things, James. So look crazy.
Okay. So look forward. Do the rates continue to go up? Because as long as they're going to continue the deficit spending, they're going to continue the money printing, they're going to continue inflating the currency, the monetary pool. And so inflation is not going to go down. And so I think it's very reasonable the Fed is not done raising rates and they'll do more, maybe even at the next meeting.
Yeah, I don't think, if I had to bet, they'll probably raise it again. If you said right now, hey, what are you putting your money on, raise or not raise? As of this second, I'd probably say yes. My concern is 0.25 and up. Depends on what's going to come out. How many more banks are going to go down, right? Because when those banks fail, like you mentioned, these mortgage bonds, these bonds that mortgages rely on, well, they start to lose value. And when they lose value, mortgage rates have to go up, because now for me to buy those bonds, I got to pay more, and we can't get that secured shelter. And then, oh, by the way, what is it? The end of this month, June 1st, the debt ceiling, that meeting's going to come up. What's going to happen there? We shall see. Look, Saturday on Mortgage Gumbo, we'll have the new jobs report that'll come out, the BLS jobs report. That will have come out. I've got the JOLTS report. There's a lot more data that we'll have for you, and we'll get into this a little bit more if need be. Hey, the home away from the show is mortgagegumbo.com or snapsendandsave.com. Folks, The cost of waiting is only going to go up. We're seeing mortgage applications, even in this environment, when it comes to purchases and refinances, are going up. Snap, send, and save. Dad Cam. Hey, we'll see you Saturday on Mortgage Gumbo with Dwayne Stein.